You land in New York City right after Zohran Mamdani's election shock. In the 5 days following his win, 41 luxury condos, co-ops, and townhouses priced at $4 million or more go into contract. That's not a retreat, it's a surge. In the week before Election Day, there were 37 such contracts, making it the third straight week with more than 30 deals at $4 M+. A rare streak in Manhattan's high end. More than half of the post-election deals, 24 of the 41, are signed between November 5 and November 9, according to Olshan Realty. At the same time, brokers are calling, ultra-wealthy clients are pausing deals, asking, where should we go? And how much would it cost to leave? The city braces for 1 million rent-stabilized units potentially frozen, a $100 billion public housing plan, a 2% millionaire income tax, and a corporate tax hike to 11.5%. Today you stand at the crossroads. Fear is everywhere. And the elite are reacting, but not in the way many expected. Mamdani's win lands like an economic quake, and the ground is shifting under real estate. His platform calls for a citywide rent freeze for all stabilized tenants, potentially affecting 1 million units. He promises to build 200,000 publicly owned, rent-stabilized homes funded with up to $100 billion in municipal bonds. To pay for it, he plans to raise corporate tax rates to 11.5% and impose a 2% tax on income earners above $1 million. These are not small tweaks. They fundamentally challenge how New York property makes money. Investors, developers, and landlords start rethinking their models. The very expectation of policy change rewrites deal timelines, risk assessments, and buyer behavior. In seconds, political risk becomes a real estate force. You meet the different faces of demand in this city. Ultra-luxury buyers, institutional players, and wealthy New Yorkers eyeing an exit. Some buyers, spooked by tax policy, press pause. Brokers tell of multi-million-dollar deals grinding to a halt. In online Upper East Side groups, residents quietly plot escape routes, weighing life in Florida. Others, driven by urgency, double down. They close quickly, afraid further tax hikes could squeeze out gains. Institutional investors, watching policy risk, delay acquisitions of small rental buildings. Meanwhile, phone lines to Florida brokers light up. In Palm Beach, agents report New York clients dialing in more seriously, more urgently than before. The message is clear. People are reassessing whether New York is home or just a volatile investment. Developers feel the tremor. The ultra-prime luxury pipeline still looks productive. Contracts are flowing, but the playbook may be changing. Some firms begin to pivot, rethinking ambitious tower projects in favor of mid-luxury or affordable housing. Bet hedging on Mamdani's public housing priorities. Brokers warn sellers, expect longer listing periods or price adjustments. Rental market professionals reposition, advising clients to lean into stabilized, policy-aligned properties. Underwriting assumptions shift overnight. Rent freeze risk, tax risk, and the political will to build public housing all warp models. This is not just delayed sentiment. It's a strategic reset. You run the numbers. Owning in New York was already difficult. But now the cost stack is compounding. The median asking rent sits at $3,397, up 5.6% year over year and more than 18% above early 2020 levels. Landlords, squeezed by operating costs, worry a proposed rent freeze could shave predictable revenue, add in higher insurance, maintenance, and assessments. For buyers, the math gets steeper. Mortgage payments, property taxes, and now an implicit risk premium for possible tax hikes. A 2% millionaire income tax and an 11.5% corporate rate raise after tax costs. Some investors, especially those acquiring small buildings, say they are rerunning their models. With the freeze, the upside vanishes or becomes far more uncertain. The sums are no longer clear, and risk creeps into every line item. The data tells a split story. On one hand, luxury contracts are surging. On the other hand, pending sales dip. The week of June 29th to July 5th, just after the primary, saw fewer pending deals. According to Redfin, even though the primary was on June 24th, but fewer deals are falling through now than in the volatile months of April and May, when stock market jitters and tariff fears derailed negotiations. Rent keeps rising, regardless of election drama. Brokers report more clients texting, "I want to sell," yet the high-end market isn't crashing. Instead, it's fracturing, some buyers cashing out, some rushing in, and many watching the same numbers but drawing wildly different conclusions. You shift the lens. Political risk is not the only threat. New York's potential exodus points to Florida, but Florida is no risk-free haven. Between April 2020 and July 2024, Florida's population grew by more than 8% per U.S. Census data. In the same period, the median sales price soared by over 60%, according to Redefine. But climate risk creeps in. Hurricane-prone areas, floodplains, and surging insurance premiums are squeezing homeowners. In places like Miami and Cape Coral, record numbers of homes flood the market as insurance costs and property taxes spike. For high-net-worth New Yorkers, relocating isn't just about taxes, it's about weighing one kind of volatility against another. You examine the political infrastructure under Mamdani. The city budget looks stronger than many expected. Tax revenues are running ahead of projections, and the budget gap is shrinking modestly. But watchdogs warn that federal spending cuts could erode the cushion. Meanwhile, Mamdani's grand proposals, rent freeze, tax hikes, public housing, need more than just his signature. He must navigate the city council, the state legislature, and potentially the courts. Some real estate leaders privately say he's more capable than he seemed. On the campaign trail, RXR CEO Scott Reckler calls him better as a communicator than expected. But the risk remains. Promises may stay in timeout, even as investors price in the possibility of big changes. Trust fractures when every deal feels like a bet on legislation, not bricks. In this uncertain landscape, technology becomes your compass. Brokers lean on real-time analytics, migration heat mapping, and predictive models to simulate worst-case and best-case scenarios. Rent freeze, tax hikes, insurance shocks. Landlords and developers run cash flow stress tests using automated underwriting tools. On top of that, a proposed minimum wage of 30 hours by 2030 accelerates automation in services, pushing building owners to invest in tech for maintenance and operations. Data tools don't just help explain risk, they amplify it, showing possible downside in clear, quantifiable terms. When models blink red, decisions get faster, not slower. Now you look ahead. In the next few months, you can expect contract momentum to continue, but buyer hesitation may deepen. Over the next 6 to 12 months, developers may pivot pipelines toward mid-luxury or affordable housing, and investors could either re-enter or exit, depending on policy clarity. Longer term, the market is testing itself. Public housing ambitions, tax reform, and migration flow will reshape New York's real estate DNA. Here are the hard numbers to remember. 41 ultra-luxury contracts in the 5 days after the election. Verse 37 the week before. 1 million rent-stabilized units could be frozen. $100 billion public housing plan.